So let's give you a bit of a background to the conversation we're having next, and that's at the debt market. Last week, the central bank conducted two auctions as far as the treasury bills was concerned. The open market operations, which was conducted, there were no sales because bidders were bidding 12.15%, above the 12.15% as the stop rate across the what the central bank offered. So that was an issue here for the first time because the rates were so high by investors. The central bank made no sales. But again, if you look at what we're looking at for last week, we saw inflows on Thursday for matured treasuries, 314.77 billion naira. That was very heavy on Thursday, just before Friday, last treasury auction, and the rates were stopped, and the central bank just said no. So then you look at this week. What are we looking at? 620 billion.58 is what some analysts say we're looking at inflows into the market this week. One, because of the FAC disbursements. They finished their meeting last week, and they decided to share about 714 billion naira. Part of that will start flowing into the market this week. Then you have the matured open market operation treasury bills, about 295 billion. That will be coming through on Thursday this week. So keep that on tap as you look at the marketplace. Then you look at the yield across the treasury bills and the bond market. We look at the treasury bills, average yield rose 25. That's for bonds. That's the Naira bonds last week. A bit of these are part of the conversations we'll have next as we try to look at the yield curve. Let's bring the Associate and Team Lead for Fixed Income Research at AfriInvest to the conversation. Jolomi Odonghanro is joining us at the Stock Exchange, where our studio is downtown Lagos. Good morning, Jolomi. It's good to have you here on the program.
Morning, Wilson.
Yeah, let's use last week trading as a mirror for this conversation. What does it show us when yields or stop rate by investors continue to rise, and at a particular auction, the central bank made no sales?
Okay, I'll take you to the primary market auction that happened last week. So what we saw at the primary market auction was that the stop rates actually went up quite a bit. And given that it was sort of an indication, markets sort of took it as an indication that maybe rates were started to trend upwards, as most of the market expected going towards the pre-election period, as you had to ask the central bank might want to adjust the rates upwards slightly in a bid to keep a lot of the foreign portfolio inflows in the country. As you know, political risk is one of the bigger risks that foreign investors look at, and the expected trend is that there will be outflows. So a lot of the market took that as an indicator of of the fact that maybe we're moving towards that point in time where yields will start to trend up. And so by the OMO auction, what you saw is that in the 2 days that preceded the primary market auction in the secondary markets, there was actually a sell-off because investors were looking to key in at higher rates at the OMO auction that was expected towards the end of the week. But with the no sale, what we found is that by Friday, there was significant demand in the market, which eventually pushed down yields about 105 basis points by the end of the week.
Okay, so that gives us a bit of a sense of where we're coming from. All of these taking us to the end of August into September, which we are technically in today, with the 1-year anniversary of our plan to restructure our Treasury bills program of about 3 trillion naira. Where are we with that program?
There was significant headway made with regards to the specifics of that program. I mean, there were issuances of I think about 3 euro bonds over different tenors right along the yield curve, and they were successful in so far as it reduced let's say the significant, or rather the continual velocity of issuances of treasury bills that we were seeing at one point, I mean, earlier in the year. I mean, at that point, we had OMO auctions almost on a daily basis as the central bank tried to keep liquidity in the system down down. Obviously, the rates were quite attractive, and so the market keyed into that. But ever since that happened, and with the issuances of those euro bonds, OMO auctions are down to about a day a week now, usually on the Thursday. And so if you're looking from that perspective of replacing the higher cost short-term debt with a longer tenor debt at a cheaper cost, I would say that it's been a success. It's been a success so far.
Yes, it's been a success so far. But again, if you look at the plans by the government to still approach the global marketplace for further Eurobond offerings to fund 2018 budget, we're already in 2018 September. The window is closing. 30 days from now, we're in Q4. And we need to get ready for 2019 budget, where we're still trying to fund the 2018 budget, of which appropriations and funding of the capital expenditure is still not yet clear from the authorities as to how much is going out.
I mean, I'm sure you're aware about what's going on in the global market, especially in relation to emerging markets, and so it may not be, it's not completely out of it that they wouldn't. Raising debts right now in this market would not come at a decent cost. I mean, if you look at what's happening in Turkey and Argentina, what you find is that foreign investors may not be willing to take up debt of other emerging countries. Not to say that Nigeria is anywhere near the situations happening in those countries, but what that means is that investors would have to add an additional risk premium on top of what they would ordinarily have bid for Nigeria's debt at, and so it's not the most conducive time to be raising or to be issuing Eurobond debt currently.
Okay, so look at how investors are trading and what we're looking at in terms of our investors selling down on our treasury bills holding and bonds as well. Last week, we saw $986.24 million FX trading via the I&E window. That's quite significant, almost $1 billion in just 1 week.
Yeah, like I said earlier, you have a situation where foreign investors will really be looking at the political risk as we move in towards the election period, and it's basically a trend. The last election period it happened, the time before that it happened. So I mean, it's not completely out of it. We expected this. A lot of the market expected it. So it's not typically an issue with whether or not the debt is still attractive. If you look at it on a risk-adjusted basis across the emerging markets, what you find is that the debt is actually still attractive. I mean, you have issues like continual hikes in the U.S. that shrinks the differential and makes it less attractive as time goes on, but what you're seeing right now is particularly related to the risk that investors see, in our opinion, and is not a general like I guess trend should not be generally placed on whether our debt is attractive or not.
Yes, our debt is attractive. But again, if you look at the calendar which the debt office has been chasing, we're now in September, and the office will be conducting the next auction in a few weeks. Also this month is the MPC, 24th and 25th of September, which is just about 3 weeks from now. What's your outlook on rates? Do you see the stop rate at the Treasury's auctions as an indication of, or a bit of a signaling of what the MPC will likely do next, considering a few of these members were asking for or voted in favor of a rate hike when they met last in July 24th to be precise?
Okay. Yes, like you rightly said, some MPC members did ask for rate hikes, but we don't believe that there will be a rate hike because it would be counterintuitive. What you find is that the rates have been able to be adjusted or moved without adjustment to the MPR. So it's right now, if you adjust in the MPR, more than likely all you're going to really do is further impact growth because it won't really affect the yields in the market. You can do that without affecting the MPR. So that doesn't mean that we do not see yields going up. Like we said, our expectation has always been that going towards the election, yields would have to trend upwards as foreign portfolio outflows may strengthen without this. So what we expect is that yields will go up, but we do not expect the MPC to have to adjust the rates upwards to get that.
So what's your outlook on interest rates if we're not raising rates in September? When is it likely to happen? What's the outlook from Afrinvest?
We do not see, like we said, we do not see interest rates going up. If the CBN can affect rates upwards without directly affecting the benchmark interest rates. I mean, in the same markets, we've had the benchmark interest rate at 14% for a while now, but in the same market, we've traded treasury bills at 18.5% discount. And right now, we're trading those same treasury bills of similar tenors at around 12.15%. So it's possible to affect the rates, the interest rate, or the rates you get on fixed income assets in the markets without directly changing the MPR. So we do not expect a change in the MPR. Like you said, it's counterintuitive for us. More than likely, down the horizon, when you're looking at growth, you might want to affect it. But right now, with regards to affecting the rates on the markets, that is what going to keep FPIs in the country, or those FPIs that are not as risk averse as the others in the country. You don't necessarily have to touch the MPR.
This is your Jolomi. This is your MPR, and this is the spot rate of about 12.15%. The gap is closing. So, are you concerned, or you worried, or you're comfortable with this level of this closeness between MPR and the stop rate at which investors are asking the Central Bank to say, this is the rate I want you to pay me for taking this money from me?
I mean, like I said, the relationship may not be the way it's a bit different. The 12.15% is still a yield of about, depending on the tenor, 12.5 to 13%. So in this market right now, with inflation where it is, and the dynamics of the market looking, I mean, the growth potential is still strong. Afrinvest sees GDP going at 2.1% this year. Yes, that's still below the population growth of 2.6%, which is the real way to measure GDP per capita, is the way to really measure whether or not GDP is growing as strongly. But we're happy with the differential right now between the rates in the market and the inflation. So I mean, an MPR of 14% doesn't worry us at the moment. And like I said, yields in the market can go up without the MPR being directly affected, which we see happening in Q4 prior to the election. So we're comfortable at these levels.
Okay, that's your take. From Afrinvest, Jolomi Odonghanro, thank you very much, an associate and team lead in terms of FI, which is fixed income.